You have been lied to since the very first day you stepped into a classroom. Society operates on a linear equation that is drilled into our subconscious. Input equals output. If you want better grades, you study longer hours. If you want to build a house, you lay more bricks. If you want a promotion, you stay late at the office. This logic serves us well in almost every endeavor in life, but it is absolute poison in the financial markets. When ambitious individuals bring this hustle culture mentality into trading, they believe that staring at the charts for 12 hours a day will result in 3 times the profit of someone who stares for 4. However, the market is a non-linear environment where effort does not correlate with reward. In fact, trading is arguably the only profession where working harder can directly result in losing money faster. The market does not care how much you sweated over a trade or how much research you did. It only cares about your entry, your exit, and your position size. By trying to force the market to pay you for your time, you are setting yourself up for inevitable failure.
Clicking the mouse button more frequently does not print more money. Usually, it just sets your capital on fire. The most immediate side effect of applying hard work to trading is the compulsion to be constantly active. You feel that if you are not in a trade, you are not working, and if you are not working, you are not earning. This leads to overtrading, which is the silent killer of portfolios. Every single time you enter the market, you pay a toll in the form of spreads and commissions. These transaction costs might seem negligible on a single trade, but when you try to work hard by taking 20 trades a day, the friction costs compound aggressively. You effectively start your day with a massive handicap, needing to generate significant returns just to break even against the broker. Furthermore, high-frequency discretion usually leads to lower quality setups. Instead of waiting for the perfect A-plus setup that aligns with your strategy, you begin firing at anything that moves because your brain equates activity with productivity. You are not trading the market. You are trading your need to feel busy.
More information does not equal better decisions. In trading, it usually equals totally paralyzing confusion. The hard worker believes that if they just add one more indicator, read one more financial report, or subscribe to one more newsfeed, they will find the missing link to unlimited wealth. They clutter their charts with so many moving averages, oscillators, and trend lines that they can barely see the price action underneath. This is known as analysis paralysis. When you work too hard at analyzing, you create conflicting signals. Your RSI says sell, your MACD says buy, and the news says hold. The harder you work to synthesize every variable, the more hesitant you become at the critical moment of execution. Professional trading is about filtering out noise to find a clear signal, but the hard-working amateur does the opposite. They invite the noise in, thinking it is valuable data. This cognitive overload leads to hesitation, missed entries, and the eventual mental breakdown that occurs when you realize that despite knowing everything about the market, you are still unable to pull the trigger profitably.
Staring at a candle will not make it move in your direction, yet traders exhaust themselves trying to will the price to move. This is the trap of micromanagement. When you feel the need to work hard, you feel the need to control the outcome. You enter a trade and then sit glued to the screen, watching every single tick, your heart rate fluctuating with every green or red pixel. This hyperfocus causes you to react to insignificant market noise. A normal pullback looks like a reversal to the hypervigilant trader. Because you are working so hard to protect your capital, you prematurely close winning trades out of fear, or you constantly move your stop loss to break even before the trade has had a chance to breathe. This behavior is akin to planting a seed and then digging it up every hour to see if the roots are growing. You are choking the life out of your positions because you cannot sit on your hands. The market requires space and time to play out, 2 things the hard worker refuses to grant.
Your brain has a limited battery life for making high-quality decisions, and trading drains this battery faster than almost any other activity. Psychologists call this decision fatigue. Every time you analyze a setup, weigh the risks, calculate a position size, or resist the urge to intervene, you deplete your willpower reserves.
The trader who tries to work hard by grinding through the Asian, London, and New York sessions consecutively is setting themselves up for disaster in the final hours. By the time the best opportunities might appear later in the day, their cognitive resources are completely exhausted. They begin to make impulsive errors, skip their rules, and take shortcuts because their brain is literally too tired to maintain discipline. It is usually during these final hours of hard work that a trader gives back all the profits they made during the morning. Elite performance requires peak mental clarity, and you cannot maintain peak clarity if you are treating the market like a factory shift that requires constant manual labor. Rest is a weapon, but the hard worker sees it as laziness.
The market does not care about your daily income goal, your mortgage payment, or your desire to hustle. One of the most dangerous byproducts of the hard work mentality is the expectation of linear consistency in a volatile environment. You might sit down at your desk determined to make $500 today because that is what your business plan dictates. However, the market might be in a choppy, low-volume consolidation phase where no valid setups exist. The hard worker refuses to accept this. They believe that if they just look hard enough, drop down to lower time frames, or force a trade, they can extract their daily quota. This creates a disconnect between market reality and personal expectation. You cannot force the market to give you an opportunity. If you are a surfer, you cannot work hard to create waves. You can only wait for the ocean to provide them. Traders who try to manufacture setups out of thin air because they want to feel productive are essentially gambling against the laws of probability. You are fighting the ocean, and the ocean always wins.
Humans are biologically wired to seek rewards for their actions, but in trading, this wiring can lead to a severe addiction loop. When you equate hard work with constant interaction, you are often just chasing dopamine hits. Entering a trade creates a rush of excitement and anticipation, simulating the feeling of productivity. When you win, the brain releases dopamine, reinforcing the behavior. When you lose, the brain releases stress hormones that trigger a fight or back response, urging you to work harder to fix the loss. This cycle turns the trader into a rat in a cage, constantly pressing the lever hoping for a pellet. The hard work becomes a mask for compulsive gambling. You tell yourself you are analyzing the charts, but in reality, you are just looking for the next fix. Real professional trading is often incredibly boring. It involves hours of doing absolutely nothing, waiting for a specific set of criteria to align. If your trading feels exciting and fast-paced like an action movie, you are likely doing it wrong and damaging your long-term profitability.
If you dig for gold in 10 different shallow holes, you will find nothing. You must dig one deep hole to find the treasure. The hard-working trader often falls into the trap of strategy hopping. When a strategy inevitably faces a drawdown period, which all strategies do, the hard worker assumes the failure is due to a lack of effort or a flaw in the system. They immediately go back to the drawing board, scraping the internet for a new holy grail indicator or method. They spend weeks backtesting, tweaking parameters, and optimizing rules, believing that this effort is the path to success. This is a mirage. By constantly changing your approach, you never gain the statistical sample size needed to truly master an edge. You are perpetually a beginner, restarting the learning curve every few months. The traders who make it are not the ones who work hard at finding new strategies. They are the ones who have the discipline to stick to one boring strategy through the difficult times. Constantly reinventing the wheel is not progress. It is a form of procrastination disguised as work.
Anger is the most expensive emotion you can bring to the charts, yet it is the natural response to unrewarded effort. When you put in massive amounts of hard work and the market hands you a loss, it feels personal. You feel cheated. You feel that you deserve a profit because of the hours you sacrificed. This entitlement triggers revenge trading. You immediately jump back into the market with a larger position size, trying to make back what was taken from you. You abandon your risk management rules because you are now operating on pure emotion. You tell yourself you are going to grind it out and fix the mistake, but you are actually spiraling out of control.
Emotional capital is just as important as financial capital. When you deplete your emotional reserves by fighting the market, you make irrational decisions that compound your losses. The market is not an opponent to be defeated through brute force. It is a force of nature to be navigated. Trying to muscle your way back to green is the fastest way to blow up an account. In the gym, doing more reps generally builds more muscle, but in trading, the curve of productivity inverts sharply. There is a specific point known as the point of diminishing returns. For the first few hours of the day, your focus is sharp and your analysis is crisp. However, past a certain threshold, every additional hour you spend in front of the screens actually reduces your overall performance. You start seeing patterns that aren't there, faces in the clowns. You begin to rationalize bad trades because you have been sitting there for so long that you feel you owe it to yourself to take a position. The most profitable traders often trade for only 1 or 2 hours a day during peak volatility. They understand that trading is a sprint, not a marathon. The trader who sits there for 14 hours is not displaying dedication. They are displaying inefficiency. They are diluting their edge with fatigue and boredom. To increase profits, you often need to reduce your hours, a concept that is completely alien to the hard work mindset.
You cannot outwork the inherent randomness of the market, no matter how much you study the past. Hard workers often suffer from the delusion that if they just analyze the variables deeply enough, they can eliminate risk and predict the future with certainty. They obsess over every macroeconomic data point and geopolitical event, trying to build a perfect model of the world. But trading is a game of probability, not certainty. Even the best setup with the most rigorous analysis has a significant chance of failing. When you work hard to find certainty, you become rigid. You become married to your bias because you invested so much time forming it. When the price moves against you, you refuse to cut the loss because the data says I'm right. You ignore the reality of the price action in favor of your hard work. Accepting that you can do everything right and still lose is a psychological hurdle that requires humility, not hustle. The market rewards those who manage risk in uncertainty, not those who try to conquer it with volume.
A tired trader is a broke trader, and the physical toll of the hustle lifestyle eventually manifests in your P&L. Constant stress, lack of sleep, and skipping meals to stay glued to the screens degrade your physical health. This is not just a wellness issue, it is a trading issue. Your physiological state dictates your reaction times and your emotional regulation. When you are burned out, your cortisol levels are high, which heightens fear and aggression, two emotions that destroy trading performance. You become jumpy, irritable, and unable to tolerate the distress of a drawdown. You might miss a perfect entry because you were too slow to react, or you might panic sell at the bottom because your nerves are shot. The grind never stops mentality leads to a breakdown where the trader simply cannot function anymore. Longevity in this game requires pacing. You are an athlete of the mind. If you do not treat your body with respect and rest, your mind will fail you when the volatility kicks in, costing you far more than the time you saved by not sleeping.
Complexity is the refuge of the insecure trader who believes that simple things cannot possibly work in such a difficult market. The hard worker builds elaborate trading plans with 25 conflicting rules. They create a system so intricate that it requires a PhD to interpret. They feel that if a strategy is simple, it is not work, and therefore it is not valuable. However, in the heat of battle, when the market is moving fast, complexity is the enemy of execution. You need to be able to make split-second decisions. If you have to check a dozen different parameters before entering, you will miss the move. Some of the most successful traders in history use incredibly simple concepts, support and resistance, basic trend following, or simple price action patterns. They do not work hard at complicating the process. They work hard at mastering the basics. They strip away the clutter to reveal the core truth of the market. Profits come from executing a simple edge consistently, not from building a Rube Goldberg machine that looks impressive but fails to function under pressure.
Chasing a move is the hallmark of a worker, not a risk manager. The hard worker feels a deep sense of inadequacy when they see a big market move that they were not a part of. They view a missed opportunity as a personal failure, a sign that they weren't watching closely enough or working hard enough. This triggers FOMO, the fear of missing out. They see a green candle shooting up and think, I have to get in now or I'm not doing my job. They buy at the top, right into resistance, just as the smart money is exiting. This reactionary behavior is driven by the belief that you must catch every move to be successful. In reality, you only need to catch a tiny slice of the market's movement to make a fortune. Professional traders are comfortable watching the market rally without them if the setup didn't meet their criteria. They know there will always be another bus coming. The hard worker runs after the bus that has already left the station and gets run over in the process.
Stop measuring your day by the hours you sat in the chair. Measure it by the rules you followed. In the corporate world, you are paid for your time. In trading, you are paid for your discipline. The hard worker measures their success by how busy they were. I looked at 50 charts, I read 3 reports, I took 10 trades, it was a good day. This is the wrong metric. You can have a good day in trading where you do absolutely nothing because the market conditions were poor and you protected your capital by sitting on your hands. Conversely, you can have a terrible day where you worked incredibly hard, took 15 trades, and lost 5% of your account. You must shift your internal scorecard. Did you follow your plan? Did you manage your risk? Did you wait for your edge? If the answer is yes, you had a successful day, even if you clicked the mouse 0 times. This mental shift is difficult because it goes against our conditioning, but it is essential for survival. Activity is not accomplishment. If your trading is exciting, you are probably doing it wrong. The hard worker seeks stimulation, but the profitable trader embraces boredom. The reality of professional trading is that it consists of 90% waiting and 10% execution. It is like being a sniper lying in the grass for days, waiting for one perfect shot. The hard worker cannot handle this silence. They feel the itch to do something. They invent reasons to trade. They zoom into the 1-minute time frame to find volatility that doesn't exist. They start fighting the market just to feel alive. Learning to be bored is a superpower. It means you have the discipline to subordinate your need for action to the reality of the market. When you can sit and watch the screen for 4 hours without clicking a button because your setup isn't there, you have achieved a level of mastery that the hustler will never understand. Money is transferred from the impatient to the patient. The hard worker is impatient. The smart trader is profitably bored.
You can do everything right and still lose money today. Accepting this is the key to longevity. The hard worker is obsessed with the outcome. They believe that if they put in the work, the result must be positive. When the result is negative, they spiral. But in trading, the outcome of any single trade is random. Your edge only plays out over a large series of trades. You must detach from the result of the immediate trade and fall in love with the process. A bad trade is not a losing trade. A bad trade is one where you broke your rules. A good trade is one where you followed your plan, even if you lost money. The hard worker judges themselves by their daily P&L, leading to emotional volatility. The professional judges themselves by their adherence to their system. By focusing on the process, the one thing you can control, you eliminate the stress of trying to control the outcome, which you never had power over in the first place. This detachment is the only way to survive the inevitable drawdowns of this business.
The best traders look lazy to the untrained eye because they have automated their decisions. They do not hunt for food every day. They build traps and wait for the prey to walk in. This is strategic laziness. Instead of working hard to analyze the market every second, they set price alerts at critical levels. They walk away from the screen. They go to the gym. They live their lives. When the alert goes off, they return to the desk, execute the plan, and leave again. This efficiency preserves their mental capital. They are not grinding, they are flowing. They let the market come to them, rather than chasing the market. By reducing their screen time, they reduce the temptation to take bad trades.
They have structured their routine to minimize the need for willpower. The hard worker thinks this is slack, but in reality, it is the ultimate form of optimization. By doing less, they extract more. They are not paid for their labor. They are paid for their patience and their precision.
Hard work in trading is not about chart time. It is about the internal work of self-mastery. We are not saying you should not work hard. We are saying you need to redirect where that effort goes. Don't work hard at staring at screens. Work hard at reviewing your journal to find your psychological leaks. Work hard at backtesting so you have unshakable confidence in your edge. Work hard at meditation or exercise to keep your mind calm under pressure. Work hard at sitting on your hands when you want to click. The hardest work in trading is doing nothing when there is nothing to do. It is the discipline to walk away when you have hit your daily loss limit. It is the resilience to come back tomorrow after a losing streak without changing your strategy. This is the invisible hard work that pays off. Stop grinding the charts and start grinding your discipline. If you can make this shift from external hustle to internal mastery, you will stop killing your profits and start building a career that lasts.